I'd like to introduce Ed Rimmer, who's Chief Executive for Time Finance, and also James Roberts, the CFO, and they'll be taking you through the presentation in the next half hour or so. So welcome, Ed, and welcome, James. And I shall slip away into the background and meet up with you at the end to host the Q&A session in about half an hour's time.
Thank you, Mike. Well, good evening, everybody. My name's Ed Rimmer, and I'm recently appointed into the full-time role of CEO at Time Finance. I joined the original 1PM business back in June 2017, and then left in April last year and rejoined as interim chief exec at the start of March this year. Prior to 1PM, I worked for Bibby Group for nearly 22 years, 17 years in the financial services division, 5 years of which were spent as chief exec for the UK, driving the business forward and ultimately leading the business to being the largest independent player in the invoice finance market in the UK. So that's a bit of background about me. I'll pass over to James to introduce himself.
Thanks, Ed. Yeah, good evening, everybody. I'm James Roberts. I'm the CFO of Time Finance. I joined Time Finance, similar to Ed, back in 2017. I think we were within about 3 or 4 weeks of each other either way as the CFO. So I've been here now just over 4 years. My background is over 20 years in financial services, qualifying initially as a chartered accountant with PwC in the city, and then in a variety of roles in financial services from early stage growth companies through to buy and build AIM listed companies. But as I say, the last 4 years spent as the CFO of Time.
Okay, thanks, James. So we'll get into the presentation, and I will just share my screen. Okay, we've done the summary of who we are. So who are Time Finance? Well, in short, we're an AIM listed provider of finance to UK SMEs to support their growth plans. The business has been around nearly 20 years. It started off, as I mentioned earlier, as 1PM, predominantly as a provider of small ticket leasing soft asset business down in Bath, and has progressed quite a lot since then, mainly since 2015 when a series of acquisitions started. What do we do? Well, I could read out that screen, but I'll try and make it a little bit more straightforward. In simple terms, we borrow money from predominantly the banks. We're not a deposit taker ourselves, so we're a tier 2 funder. So we borrow money from the banks at hopefully the best rates we can get, and then we lend it out to small businesses at a margin. Within that, we provide a range of services which attract additional fees, and with the net interest margin and those additional fees, that totals our income, and then we have to run the business in the normal way with people, processes, systems, and property. And the key thing is managing bad debts and credit risk, hopefully to a minimal level, so that we make a decent level of profit. And in simple terms, that's what we do. We deploy the money into 4 areas: asset finance, invoice finance, loan finance, and vehicle finance. And we lend money on our own balance sheet, or we can broker out to other lenders if it doesn't meet our credit criteria. In terms of some numbers, we lend money and facilities provided to around 20,000 UK SMEs. We originated last year, our financial year end has just passed, which is May. We originated around £100 million worth of facilities, either on our own book or broked out. That was slightly down on the previous year due to the disruption of COVID, but nevertheless still a healthy figure. And we actually increased our value of our balance sheet in terms of the net asset value during COVID, from around 26.5 million up to just over 28 million at the end of May. As well as James and myself, who are the two executive directors, we have a very experienced and very capable team of senior management. We have 3 directors of products that you can see at the bottom of that screen in terms of assets and loans and invoice and our broking activities. The assets and loans division is due to be separated out at the start of September with a new recruit joining us who will head up the loans business, which I'm very much looking forward to, and that will give that division a bit more guidance and vigor to move forward as a separate division. We then have 4 directors of functions in terms of compliance and governance, HR, risk and IT, and that is our senior management team. We're award-winning or award-nominated, which is always nice to see, and good recognition for our teams of people who put in a lot of hard work behind the scenes. I can't lay claim to a lot of these, having been out of the business for nearly 12 months, but it is nice recognition from our wider staff. In terms of the detail of our products, I'll just take you through some key points. Asset finance is the largest of our divisions. That equates to about 60% of our current lending, and we provide finance in soft assets and hard assets. So soft assets typically don't have a residual value at the end of the lease, things like catering equipment, gym equipment, and the likes, whereas hard assets do, things like diggers, cranes, tractors, trucks, things like that. We get our business from professional firms, so accountants, brokers, and we have programs with vendors such as suppliers and manufacturers to help them ultimately sell products and put a leasing facility in place, which we provide. Our ticket size ranges from a minimum of 5k on soft asset up to a maximum of 250 on hard asset. Our sweet spot is around 10k on soft and 50k on hard. And our typical yields, 9% is the minimum we'll go down to on the better quality hard asset deals, and up to 18% on the smaller soft asset deals. That division is funded through wholesale block facilities, mainly provided by the challenger banks. Invoice finance is for funding sales ledgers to release much needed cash flow for working capital purposes for small businesses. Disclosed and confidential, more commonly known as factoring and invoice discounting. Again, the business comes from finance brokers, professional firms, insolvency practitioners, accountants and the like. Facilities range from small end 10k up to 2.5 million. Our sweet spot is around the 200 to 400k mark. Better quality, larger deals will go down to an 8% yield. Smaller factoring deals typically are higher at up to 18%. And the funding for that division comes from a high street bank back-to-back facility. Our loan products is twofold. We do loans off our own balance sheet for commercial loans, and we do loans that are broked onto other lenders for business to consumer. So that is buy-to-let and residential mortgage providers. In terms of our own book, typically comes from brokers and professional firms again. Deal size of 5 to 250k. Sweet spot unsecured about 25k, and secured, which would normally be on a second property charge, around 100k, and typical yields between 12 and 18%. That division is funded by also the block funders, who allocate a part of their facility to providing loans, but also a high net worth loan note program. The vehicle side is all brokered out. The business to business side is commercial fleets, small fleets of SMEs typically. That is slightly different in terms of where we get our business from. It tends to come more direct through social media channels and also client relationships that we renew. Deal size typically 15 to 150k, sweet spot around 35k, and much typically lower yields from tier one funders, which is all, as I say, brokered out. We do have another business to consumer side of the vehicle finance, which is Car Finance to You, which has been left as a separate brand. That does something quite different, which is used car finance. It's a much lower tier of credit. It's all broked out, but it's all business to consumer. And I'll touch on that, that business again a little bit later in the presentation. In terms of where we stand out from the crowd and our wider market, well, there's lots of providers of financial facilities to SMEs. Some of them are the banks, some of them are the challenger banks that generally came about through 2008 onwards after the financial crisis. There's a number of fintech platforms. There's other quoted companies that do things similar to ourselves, at least on part of our products. And then there's smaller private companies who tend to be more regionally based. I think if you take the spectrum of competition, the banks clearly have a wide range of products they can offer, but they're not really any more associated with flexibility, speed of response, and providing a personal approach. The private smaller companies typically are, but they wouldn't tend to have a wide range of products. They would tend to be a single product provider. So across the spectrum of our competition, we're not absolutely unique, but we do believe we sit in a much more smaller, unique pool of businesses that provide all of those things. And the wide range of products is a key part that we will look to focus on in our future strategy. And I'll talk about that in more detail in the second part of my presentation. But at this point, I'll hand over to James, who will just take you through some numbers.
Thanks, Ed. Appreciated. Thank you. Yeah, so I'm just going to very quickly talk through where we are currently financially in terms of the balance sheet and what we've done over the last year, and then perhaps more excitingly where we think we can take the business going forward before handing back to Ed to explain how we're going to take the business forward. So in terms of where we are as a snapshot, we feel we've we've done okay. It's been a solid achievement in a relatively challenging year. We have remained profitable, profit before tax and exceptional items of about 3 million, which is flat on the year before. So after 12 months of COVID impact for the whole financial year, we've managed to maintain our PBTE. At the same time, we're particularly proud of what we've done on the balance sheet, and I will come into a bit more detail on this, but at a high level, we have over 8 million in cash, which is some 6 times the level we had 12 months before, and our balance sheets continue to strengthen, and our net tangible assets now stand over 28 million. So we feel we've got a solid base from which to grow from. In terms of the balance sheet, drilling down in a bit more detail, balance sheet obviously is key in our mind as primarily an own book lender. The quality of the book, the amount of cash you've got, and the value of your balance sheet are absolutely key to us. And looking at those in a bit more detail, we can see that despite COVID hitting in the final quarter of our financial year in 2020, and as I said, for the full 12 months of this financial year, we have in both those periods managed to increase our net tangible assets from just over 25 million to sort of 26.5 million by May 2020, and then on to 28.3 million as at 31st of May, a couple of weeks ago at our year end. At the same time, focused on cash conservation during the past 12 months, de-risking our book. Some of the deals that were perhaps more concerning, we've managed to move on maybe into other funders elsewhere, such as the bounce back loan scheme, etc., that we didn't have. And that's generated more cash for us. And we've tightened our credit policies during the pandemic, fewer new starts, fewer things in hospitality and things, because the model is very flexible. We can move from where we lend in terms of the sectors. And what that's done has meant we've got over 8 million of cash at 31st of May, which is the highest it's been for a number of years. And cash is vital because it's the fuel for growth. In terms of how we lend to UK SMEs, we tend to put in between 10 and 20% of the cash in every deal. So obviously having 8 million of cash to deploy gives us a reasonable war chest to grow that book as we come out of COVID over the next 6, 12, 18, 24 months. We've got a bit of firepower to really take advantage of the opportunities that hopefully we'll see ahead of us. The other aspect is the lending book itself, and that is crucial. When COVID hit, there was a lot of concerns over companies and in terms of our lending not being able to be repaid, impairments and arrears and eventual write-offs impacting the business. And you can see that in that third column, arrears movement. The movement from May 19 to May 20 saw an increase in arrears driven by that final quarter, which was the beginning of COVID, of 8.2 million. But something we're particularly proud of as a business and the efforts put in by our colleagues in credit and risk is over the past 12 months, despite ongoing lockdowns, the impact of lockdown 1, then 2, and then in January through to March, lockdown 3, the work we've put in, we've actually managed to see arrears fall by 9.3 million. So as at the 31st of May 21, our arrears were lower than they were pre-COVID at February 2020. And I think that's a fantastic achievement, actually, and there's not many other lenders out there who can say that. So we're very pleased with that. At the same time, forbearance and deals in forbearance, what I mean by that is, again, COVID hit. A number of people we'd lent to would pick up the phone and say, look, my business is closed. I just simply can't pay my monthly repayments. Can you give me some form of forbearance? And we'd assess every case individually. And it might be, no, we think you're fine, you need to keep paying, or yes, you do need some form of forbearance, and we might give up to 3 months payment holiday or what have you. And as you can see there, in May, June time, we had 25 million or so of deals in forbearance. And again, over the last 12 months, that's come down significantly. And at 31st of May, it's less than £1 million. It's about £800,000. So again, a fantastic performance from our risk team in getting that down, and I think that gives us a very, very solid base to move forward from. In terms of the P&L, the revenues are down, and that is purely driven by COVID. There's two key drivers of that. The brokerage areas of our business have had to close their doors for a lot of this period. So the revenue falling from 29 million to 24, driven roughly 50-50 by the impact on the brokerages. About 2.5 million of that shortfall is due to our brokerage businesses. And given they only make up 10 to 15% of our overall revenue, the fact they've made 50% of the reduction shows how badly impacted they were. The pleasing good news is doors are opening up again on car dealers, etc., and they're beginning to come back. But they did drive an element of that revenue shortfall. The other element is the fact that our lending book shrunk. So our average deal book size over the course of the last 12 months is just over 100 million, whereas the 12 months before it was over 120 million. And if you think your average rate is in the region of 14 to 15%, having a roughly 20 million reduction in the size of your lending is another 2 or 3 million of revenue reduction. Despite that, though, our adjusted profit, our PBTE, has remained relatively flat at 3 million, similar to the year before. Two aspects to that. One, as you'd expect, if revenues are down, your cost of sales, which is your funding costs, your introducer costs, etc., have correspondingly reduced, but also very much conscious of costs over the last 12 months, and primarily staff costs have significantly reduced as well year on year. So we've managed to produce profit in line with the year before, despite having 12 months of COVID impact rather than just 3 months in the 12 months before. Some other highlights probably were, oh, sorry, Ed, could we just jump back just very quickly? Sorry, thanks. Some other highlights probably worth drawing to your attention is there is an element of uncertainty still out there, as we know. So we've maintained our bad debt provision, in fact, marginally increased it from 5.1 to 5.3 million. So that's despite the arrears coming down significantly, despite over a 95% reduction in forbearance. We think it's a prudent thing to do at the moment to keep our bad debt provision at a relatively high level should things worsen. We don't think they will, but it gives us a nice comfort blanket if they do. An indicator why we think that it won't is our write-off levels and recovery levels have stayed very much in line with historic trends. So our write-off levels are about 1.5% of our gross book, marginally up on the year before, but nothing dramatic at all. So that gives us confidence in the spread we've got, in the security we've got, the effectiveness of the PGs we have behind our deals, that we shouldn't, hopefully, touch wood, have a significant increase in write-offs. At the same time, we've got a good visibility of future income. just under 15 million, about 14.5 million of unearned income is on our balance sheet. So if those businesses perform as we think they will and expect them to, then we'll have 14.5 million of revenue, for want of a better expression, in the bag over the course of this 12 months. And as I touched on earlier, one of the key things for us is the diversification and spread of our book, meaning that we aren't impacted if one sector is massively adversely impacted. So for example, hospitality, travel have really been impacted, but our sectors are very well spread. So well, things like that are a pain. It's not the end of the world. And at the 31st of May, our largest sector was less than 5% of our overall book. By the time we got to the 10th largest sector, it was around about 1% of our book. And the top 10 in entirety is less than a quarter of our book. So we think we've got a very well spread book, which mitigates risk. So where do we want to go to? That's where we are and where we find ourselves. As I touched on, we think we've got some fuel for growth. We've got a very solid base. We've shown we're profitable even in extraordinary times. But what's arguably more exciting is where we can go from here with the vision and the strategy, which Ed is going to elaborate on in a sec. But we think over the next few years, we can more than double our lending book to gross lending book to around about 250 million, which is a significant increase in lending. And that, as I've touched on, will lead to greater revenues and in turn profit. And so that means we think we can achieve profits organically well in excess of where we were pre-COVID in 2019. And for your information, just to remind you, if you aren't aware, that there we had profit before tax and exceptional items of in the high sevens, low 8 millions. So we think we can get well ahead of that organically over the next few years, focusing on doubling our gross lending book. And all of that will lead through to having a significantly strengthened balance sheet, further strengthened from where it is today, which we think will lead to significant increase in shareholder value amongst our shareholders. So that's where we want to go. And to tell you how we're going to do that, I'll hand back to Ed.
Hopefully, yeah, I'm now off on mute. As I was saying, yeah, what we're going to do is relatively easy to sketch out. How we're going to do it is the more difficult thing. So I'm just going to take you through our forward plan for the next 4 years. Before I go into that, it's probably worth just touching on a little bit of history in terms of the business. I mentioned earlier that the business up until 2015 was predominantly a single product provider in the small ticket soft asset space, and then a diversification program came about, and that was really driven by a series of acquisitions that were done. We completed around 6 or maybe even it was 7 acquisitions in the space of 3 years. And I think if anyone's experienced acquisitions, certainly in that short space of time, you'll know that it's very difficult to get them all right. And I think that's what happened to the 1PM business. I think some of the deals were really good, and some of them weren't that good. Some of them have turned out to be better, but that's involved an awful lot of management time and people coming and going, and investment in systems and processes. So I think that definitely slowed the business down. And some of the acquisitions were definitely better than others. And I think the business became a little bit confused in the sense that we had some businesses that were business to business and some businesses that were business to consumer. And there's a big difference. Some were brokers, some were lenders. So the first point at the top of this diagram, I'll work clockwise to the right, is taking the business back to focusing on our core products, which is asset finance, loan finance, and invoice finance, building our own balance sheet as a business-to-business funder, and not necessarily seeing the brokerages, which are B2C, as core business at all. So it's really refocusing on being a secured lender in those products. The other point I should note is that our core products historically of the soft asset finance, we've taken that up to a minimum ticket size now of 5k. It still will encompass around 60% of the business that we would have previously looked at, but importantly, it will take away a lot of the very small micro deals where we end up with an awful lot of work to sift through those deals to actually produce some business. And it means that we should be more efficient, and we should still create enough business in that market, but it will be at a slightly higher ticket size and with better efficiencies for the people to work through. So that's the first angle of the strategy, which is really taking us back to core products, being a secured lender, and focusing on slightly higher ticket size in the soft asset side of the business. The second strand of the strategy is the multi-product solutions and being able to offer an asset-based lending solution. Now, lots of businesses have tried. Some have got it right, some have got it wrong in terms of being able to offer more than one product at once. I've worked in a previous business with being Bibby that had some success, but it also had some failings. And I think the difference with this business is it's a bit more smaller, it's more agile, and there's a genuine desire from the people within it to make this work because they can see that it's the one thing that differentiates us, our product mix, from a lot of our competitors. We've already started the process internally through having a cross-sell initiative. That's lost a bit of pace, as you would expect, through COVID, when the focus of the business was on other things. We're set to relaunch that XL, it's called, as an internal cross-selling initiative. We're set to relaunch that at the start of July. And we are also, as I mentioned earlier, taking on another recruit who will come in to head up the loans business, but she will also take on the responsibility to develop the ABL offering because of her experience in the various sectors. So we hope to start gaining traction with that offering internally very soon, and externally from early in the autumn. And that should see us take that whole another level. The third strand of our plan is the repositioning of the brand and the business, and some investment in marketing. The 1PM business changed to Time Finance at the end of last year. It was very much 1PM historically associated with the soft finance, small ticket asset finance business. And then as a wider business, 1PM was quite confused in a way because we had lots of brands that we'd acquired and left them as they were. Some great work has been put in over the last 12 months, rebranding the business so that we can now move forward as one brand, and we can position ourselves in the areas that we want to, as this focus on core products, secured lending, slightly larger ticket size, predominantly on our own balance sheet to build a business. We've already started that investment in marketing. We've taken on a new digital marketing assistant, and we see that as a big part of our plan moving forward in terms of the digital and online space. We've brought back into the business a head of marketing who worked with us previously, and we're looking to take the marketing side of the business forward with a slight increase in spend as well to help underpin the sales side of the business. And ultimately what we want to achieve is that when salespeople go in to talk to businesses, whether that's directly or whether it's through an intermediary, they've already heard of Time Finance and they understand what we're about and where our target markets are. If we can get to that stage, then we'll be significantly advanced along the sales process, and that will save time and effort and increase conversion. So that's the long-term aim. It will take time, clearly, to get there. We're not a brand that's well known at the moment, having only rebranded at the end of last year, but it can be achieved, and I'm confident that with the right people and the right budget, we can do that. Moving on in terms of the next strand, it's investing in further talent, and that's predominantly sales resource. The market's changed quite a lot, even though there's not a lot been going on in terms of COVID and its suppressed volumes, but the market has changed a lot. The banks really now predominantly want to lend to small businesses through people like ourselves. They don't really want to go into the micro end of the small business themselves. So that's an opportunity. And there's lots of other businesses that we would generally class as competition that have had changes as well through COVID, whether that's new management teams joining, new strategies being deployed, or moving in and out of certain areas. There's quite a lot of change happening. So what it's created is an opportunity to acquire some salespeople that ordinarily wouldn't be about. That plan is now well progressed. We've got quite a few conversations. We've already got the lady that I mentioned joining to head up the loans business. We've got a new head of sales joining for the South in the invoice finance division. And we've got 2 or 3 other key appointments that we're hoping to make as well. So putting that investment into the business is a short-term cost, but it will deliver a better long-term performance. And we have to invest in that sales talent to deliver our targets that James set out on the previous slide. The 5th strand of our plan, similar to bringing in and investing in further talent, it's acknowledging that we ideally could do with bringing in further liquidity or cash into the business. Again, as James mentioned earlier, every time we put a loan or an asset finance deal out, we're only able to draw down 85% or thereabouts from our funders. So we have to find the balance of cash ourselves. When the business is growing very steadily or slowly, that's generally okay, because the money that we collect in, you can use to lend out again. But when that model starts to fatten up and gather pace, then obviously we need additional comfort in additional finance facilities. And ideally what we could do with is more equity stroke debt into the business so that this plan can be deployed quicker, and we can go for slightly bigger ticket deals. The numbers that we've put out into the market and the presentation that we've given today is all about delivering the plan with organic growth. But we recognize that we could do things quicker with additional liquidity, and that's something that we're going to be concentrating on over the next few months. And the final part, just to mention, top left-hand side of this slide, is organic growth and targeted acquisitions. So despite what I said about the acquisitions, there was some good ones and not so good ones. We do recognize that there will be opportunities to bolster our divisions with additional acquisition opportunities. However, they will be well selected. I'd like to think that I'm pretty streetwise in terms of what we do and the businesses that we should be looking at, and they will be well selected and not just put on the books to grow the business for the sake of it. It'll be aligned with our strategy in terms of our core products, and there'll be businesses that we're well versed in, that we ideally already know. So that will be part of our plan, as well as organic growth, but there'll be specifically selected acquisitions. So just to conclude my part, the investment case by way of summary, as James said, we have shown a lot of resilience through a difficult period, and liquidity has improved. We have got a really committed and talented and experienced management team that can drive the business forward, which we'll look to add to. We've now got a clear plan for the medium term of what we're looking to achieve and how we're looking to do it. We are a business that stands out from the crowd with our multi-product offering, and we're looking for that to be a major part of our future plan. And we have a strong base to take advantages of opportunities that will come our way. And I think this is a key point, really, because there will be opportunities coming our way. There'll be threats as well, as there always is. But I went through the 90s economic cycle, the 2008 financial crisis, and then through COVID as well. And all the while, through those 3 periods, there was definitely some really big opportunities that, particularly in 2008, that the business I was previously in, Bibby, really took advantage of. And I see a lot of similarities with this business. We're small enough to be agile, do things quickly. We're not governed by loads of unnecessary bureaucracy. And I think that we can take those opportunities as they come our way. I think the key thing that I would look to achieve through that is that lots of lenders come and go, they change their goalposts, and whenever you speak to introducers, brokers, accountants, it's quite hard for them to keep track of what everyone does. If we can provide that level of consistency over a 3 to 4 year period of always knowing what we're doing and the markets we're in, That's a real USP to our introducers in terms of the consistency of doing business for them. And that's what I'd like to achieve through the course of this plan as well. So overall, I think that, we're well positioned and primed for growth, and hopefully we have an exciting plan ahead of us. At that point, I think we're now into Q&A. So I will stop sharing my screen and hand back over to Amanda and Mike.
Well, thank you, Ed, and thank you, James. So we've had quite a few questions coming in whilst you've been talking. So just picking them off the top at the moment. You've partially, I think, answered the first one here, which was really just to explain the company's approach and success with cross-selling its services. Perhaps you could, and you mentioned, sort of more salespeople, etc., and trying to bundle things through existing customers and whatnot, and a more consistent offer to the market would help. But perhaps you could say what your expectations are and how well it's gone so far in terms of percentage of cross-selling activity that you've generated through, or business growth you've generated through cross-selling activities hitherto.
Sure. Well, it's not something that's completely new to the business, because we did have this initiative 2 to 3 years ago when we started it, and there was quite a lot of success. However, there's a big difference in being able to go into a business and talk about the products and then say, I'll get my colleague to ring you as well about that one because it's not my specialist area. And being able to actually confidently go into a business and talk about everything that we do. And talk about everything we do, I wouldn't just say, well, how it works. Now, I would say, what rates do we offer? What are our target markets? Where we expect to play in those? Originally, really along the slide that I took you through in terms of our target market. So it's building confidence with people that we have salespeople out on the road that are equipped to actually go and sell all our products, rather than predominantly selling one product and then bringing in their colleague to do the other. That makes a big difference. One point of contact. The other side, of course, that makes a big difference is operationally. If you start to then spread the relationship out across 2 to 3 different underwriters internally for each individual product, the whole process breaks down, and the client then thinks, well, I may as well just go and speak to somebody else because it's not a one-stop shop. So we need to get that right in terms of delivery at the front end and the delivery at the back end. Previously, it was more referrals going on across the divisions, which we had, I would say, stage 1 success with. This is really taking it on to stage 2 and stage 3 now, and it's not going to be rushed. I would caution that there's absolutely no point in rushing this, because you've got to get it right. If you mess it up to start with, people just lose confidence, and you don't gain that credibility. So we've got a project in place. I'm sponsoring that initiative. It's relatively early days, but we have sketched out what we want to achieve, and who's going to do what. And internally, we're looking to launch that in July. So yeah, that's the best I can sort of summarize really in terms of what we're looking to do with cross-selling.
Okay, thanks, Ed. I've got a couple of questions here that are linked in a way. First one saying when government support is withdrawn in the coming months and the tide goes out, how we like to see a lot of zombie companies causing problems with credit and so on. And what are you doing to protect yourself against increasing defaults in the months and years ahead? And then another one saying you seem to have been overly conservative in terms of the provisions. You've elevated them, even though you've got severely reduced arrears at the moment. And is this overly conservative? So perhaps you could just elaborate a little bit more on that, your expectations really, and why you've chosen to increase your provisions at this stage.
Sure. Well, I'll take the first part, and then maybe James can put his views in terms of the provision and the financial side of things. In terms of the point about zombie companies, yeah, I completely share that view. I think there's a lot of companies out there that avail themselves to the bounce back loan scheme and CBILS to a lesser extent. I think there's very smaller businesses were mainly around the bounce back loan scheme. I understand why it was done. I think my conclusion to all the funding schemes would be it probably was the right thing to do, and furlough was probably the right thing to do. I know businesses, friends, family, and clients that have really benefited from the schemes that potentially wouldn't be in business now. But at the same time, I think we all recognise that there's a big percentage, probably a much bigger percentage of companies than anyone thinks, that aren't going to be in a position to repay those loans, and quite frankly, took them out with the wrong mindset. So I do think there will be problems down the line. However, I think with all the way that the governments have managed the whole funding and support packages, there's not going to be a cliff edge. I just don't see that happening. It's cost the country a fortune. Why would you create absolute pressure and cliff edges to then potentially undo all the hard work you've done? So I see it as a gradual recovery, but I do see insolvencies increasing, and I do see some of the smaller businesses struggling. But that will provide us with opportunities. That's where we can help. That's where the banks don't necessarily do well, and you know, that's where our core markets can support some of these smaller businesses.
Okay, thank you. And
yeah, shall I jump in here on the
sure.
On the bad debt provision, which is a very valid point and a very good observation. And so exactly sort of the points that Ed has alluded to there is still an element of uncertainty as we look forward. And so in coming to our bad debt provision, we've tried to err on the side of caution. It's ticked up marginally, as alluded to by the questioner, from 5.1 million to 5.3. That's driven primarily because the IFRS 9 requirement has ticked up marginally during the year. I touched on when I spoke in my part about write-offs relatively flat, but going up slightly. They're up to 1.5% of the gross book. So it's a little bit higher than it was. So that in turn drives the bad debt provision. However, on top of the IFRS, if you like, the required provision, we then have a management overlay of a good couple of £1 million. And we, as a board, have decided that is the prudent thing to do to maintain that 2 million headroom, if you like, over the accounting standard requirement, just in case that there is this zombie scenario we've been talking about. And we'll see over the next 6 to 12 months how that pans out. On the one hand, if it's there, I think we're adequately provided, and so we shouldn't be seeing, touch wood, you can never say never, we shouldn't be seeing big increases in our provisions. And secondly, if it's not there, then arguably there may be something we could write back, but we certainly don't want to be writing something back and then having to re-provide later down the line. So we think we've erred on the side of caution, we've been prudent, and it's the right thing to do. So that's pretty much why the provision has stayed roughly where it was.
Okay, thanks, James. A question here on, well, it says revenue to May 20, but I guess it probably means profit to May 20. It was down significantly on the year earlier. It was so 8.3 million versus 3 million. What were the main causes for that?
Shall I take that one, Ed? Is that?
Sure.
Yeah, sure. So, yeah, I mean, we sort of touched on it there, really. It's this management overlay and largely on the bad debt provision. So in the old world, pre-COVID, we had our bad debt provision roughly in line with the accounting standards, IFRS 9 requirements. When COVID hit, we put this 2.5 million management overlay on top of that provision because we were looking forward and saying, well, if anything's going to happen, it's only going to go one way, and we want to be ahead of the game. So that had a significant depression of the profit levels in that year, even though COVID only hit for the last 3 months of our financial year. That sort of one-off management overlay hit came in that year. And then the second factor that drove it, I think I alluded to it or touched on it at a very high level, talking about the impact on revenue of the brokerages. If we jump back to March 2020, our brokerages, particularly if you put yourself in the vehicle brokerages, which are reasonable, which is the bulk of our brokerage business actually, they stopped on day one because lockdown 1 was effectively a much more stringent lockdown than we had in lockdown 2 and arguably lockdown 3. So car dealers, for example, were closed, and so people couldn't buy a car. So there was no brokerage to be made on our vehicle revenue because you couldn't get a car. So even though there was only a quarter of the year was affected by the pandemic, there were two big seismic shocks. One was huge one-off increase in provision, and secondly, the brokerages effectively stopped on day one, and they've been clawing their way back ever since things began opening in August last summer, wasn't it? July last summer they kicked off. But that 3 months at the end of the year to May 2020, they were sort of, the doors were closed.
Okay, thanks, James. A question here on the year-end high cash level you've got on the balance sheet, and the question of whether that indicates that lending volumes towards the year end were on some kind of downwards trajectory, or is that reading the wrong thing into it?
Is that one for me, Ed? I'm happy to take it unless you'd like to.
Probably one for you, James, I think.
Okay, yeah. No, so I mean, so the lending book was growing reasonably well from September time through to sort of late November, early December, as we'd emerged from, I suppose, the first lockdown and things were beginning to open up. It was the lending book was then hit in January through to March as lockdown 3 happened, and so volumes of origination then and business with our own book have shrunk a little bit. We are seeing the green shoots of recovery again now as we're beginning to open up. So it's a sort of up and down mixture, if you like. So we're certainly very cautiously optimistic over the next 6 to 12 months of lending beginning to pick back up again, but it has been impacted by lockdown 3 to a degree.
Okay, thank you. One on a question with a company with which we have a relationship here, PCF. Does the uncertainty and disruption that PCF are undergoing at the moment have an impact on you in any way? The questioner believes you broker quite a lot of business to them, and perhaps you also have funding from them.
Yeah, I can take that. We don't broker an awful lot of business to them, and we don't have any material funding from them. Look, it's never great when a business in your sector runs into difficulties, but I think the big difference comes back to the fact that we're well diversified in terms of our products. So we're not just in asset finance, we're obviously in invoice finance, loan finance, and we've still got the brokerage income as well. So we're a more diversified business, and we don't have any financial facilities from them. So not a great impact, albeit, as I say, any challenges that people run into in your sector, potentially never great, but yeah, we're a very different business.
Okay, thank you. Question on your biggest shareholder, Wellesley Cloverleaf 375. Did they attempt to take over of Time Finance with this large acquisition of shares that they made in May 2020, to your knowledge?
Not to my knowledge.
No. It was always been around about 20% holding. That's what they came in as, and that's what they still are at. Okay. In terms of dividends, I noticed in the most recent announcement you're foregoing the dividend that was expected. Do you have an expectation as to how long at this stage you'd be stopping dividends? I realise there are no promises, but can you give us any ideas or your thinking at this stage? Do you want me to take that one, Ed? Dividend point. Yeah, I think there's two things there. In the old dividend policy was in place when we pre-COVID we were making very, very different levels of profit. You know, one of the questions was your profit used to be 8 million and now it's 3 million. So we are at a different stage. We're on the recovery stage, but we're not back there yet. So on the one hand, to pay out funds that can be used for growth in dividends now, well, we're not where we were. Arguably is not the right course of action. I know with dividends it's emotive, people have very different opinions, there is no right or wrong, but we're certainly not where we were. So to pay at the previous level I think would be, we feel, is the wrong thing. And then secondly, as I think Ed hopefully got across, and I thought got across very well in his presentation, was you can see that the focus in returning shareholder value is to grow this loan book, is to write more own business on our own book and increase the balance sheet. And that will in turn result in greater profits. And when we get back to or around about where we were before, I'm sure we'll be having those conversations of whether we should reinstate dividends or not. But at the moment, let's grow the business. Let's reinvest cash to strengthen the balance sheet, grow the book, get back to where we were, and then we can have those chats again. So nothing on the horizon, in the immediate horizon at the moment.
Okay, sounds like you've got certainly one of the viewers has given you a positive thumbs up for that. He said if you were growing aggressively, why pay dividends? And there are some tax benefits, or it seems to be to this particular shareholder to see you grow the value of the equity rather than pay them dividends. So I think that's an interesting observation. Feedback for you. Now, in terms that you did mention at one point, you've acquisitions could still be part of the growth picture. How are you proposing at this stage to fund any future acquisitions?
Well, that's the challenge. I think if you recall the slide that I did in terms of the strategy, you'll remember that one of the points, point number 5, I think it was bringing in additional equity and debt into the business, and that's one of the things that will help us to go quicker, and that's one of the areas that we could use to acquire businesses. I think there's two targets, if you like, in terms of groups of acquisitions. One would clearly be a more larger transaction that would need to raise additional capital for, and we wouldn't have those resources to do that at the moment. Others would be potential bolt-on deals where there's small books of facilities, whether that be an invoice finance or asset finance. They would be the two areas that we would look to do that. There has been deals transacted like that in the past. I've been involved in those in previous worlds, and I think that's where we could potentially use our own funds to add on additional smaller books. But anything of significant size, we would need to raise capital for. Okay,
thank you. There's an email question here I omitted to cover, so I'll just cover that briefly. Today's analyst report from Equity Development shows an estimated 575k of share-based payments for this financial year, and this appears to be the main cause of a forecast reduction in OP from the levels of 2020. Can you explain what that 575k is? It's quite a large chunk compared to historical run rates and so on.
Yeah, I'll take that one if that's okay. I mean, that is the people may have seen that recently some share options vested for the senior management team. They were driven on getting the share price back from, at the time it was introduced, about 12p up to 31p, and that's relating to the issuance of those shares. So it's very much a one-off, but it has impacted in the financial year just finished numbers, the issuing of those shares.
Okay, thank you. Question here about going forward. What increase in average loan size? You mentioned you want to kind of put a minimum loan level on for some of the asset financing and so on. What increase in average loan size do you expect to achieve roughly by 2025? What's in your plans?
So I'll take that. So this is not taking the business into unfamiliar territory in terms of becoming an absolute ABL player as such. So there's a big difference in what we're talking about and what you would hear as traditional asset-based lending. The traditional asset-based lending market sees deals done quite regularly, upwards of 25 million. Now, clearly we haven't got the resources to play in that market, nor would we want to, because the risk is much higher in terms of the money that's out to any one client, and the overall net returns are lower. Obviously, what you get is a better quality of client, but that's not our market. Our market is the smaller SME sector. So whilst we're talking about increasing the average ticket size, it's all relative. So in the soft asset side, The average ticket size this year has been around about 6.5K. It's trying to take that up to about 10K. So in a percentage term, it's quite significant. But in terms of overall monetary terms, it's not taken us into a different tier of lending with a different tier of risk. It's taken us up to a more sensible average ticket size so that we can improve conversion and reduce the volume of leads that we see at the bottom end and make us more efficient. That's the main driver there.
Okay, thank you. And just another one in terms of forecast. In your plans through to 2025, what blended cost of borrowing have you assumed, given the recent, announcements around inflation and expectations around central bank rates? What's your present assumptions?
Well, I'll take that one if that's okay, Ed. At the moment, for the last 2 or 3 years, we've sort of blended cost of funds of about 4%. We've not assumed any radical change. We're not assuming we're going to get into some different type of funding, which would be a step change in reduction. But we have assumed a marginal increase year on year over the 4-year period as we move forward for pretty much the same reasons you've mentioned, Mike. But it's not game changing. I think we go from about 4% to about 4.75 over that period, but and that's probably prudent because I think as we grow, hopefully any increases will actually be offset by the fact we might be able to get into bigger benefit from economies of scale or maybe some RCF facilities or something like that, which might well offset it. But for prudence sake, in our thinking, we've got a nominal increase factored in over the years.
Okay, thank you. I'm conscious we're out of time. There's one more question just recently come in, so I'll just quickly go through that and then we'll call it quits. Why have an LTIP linked to share price? LTIPs should be linked to business fundamentals instead, revenue, earnings, free cash flow, etc. So maybe a bit of a challenge to the structure of your present incentive scheme.
I can take that one. All I can say is at the moment, with as a new chief exec coming into the business, obviously the LTIP is something that I'm obviously very interested in. The board are currently looking at that. They're obviously mindful of what's been put in the past and how that's affected the recent results, and they've taken quite a wide range of advice on that. To make sure it fits with shareholders and management. So that is work in progress, and I reassure whoever asked that question that suitable guidance is being taken to make sure that it's balanced properly.
Okay, thank you. Maybe a very short sales pitch here for one of my fellow directors on the ShareSoc board, actually, who is an expert on remuneration, particularly for AIM-listed companies, and has written books on the matter and has been consulted free of charge, I might say, on those matters by some of the companies on AIM in order to get a better feel for what would be acceptable to the smaller investor community.
Well, anything
we can do to help, he would be interested in talking to, I'm sure.
Anything that's free of charge, Mike, from people that we know, we'll be all ears. Please speak to our chairman, John Newman.
I'll mention it to my colleague and ask him to get in touch with John. Yes.
Please do.
All right. There's always a business opportunity around every corner. So anyway, Ed, James, thank you very much for spending the hour with us. I appreciate that. And I hope that we'll be able to talk to you again in the not too distant future. And I wish you well with the revised strategy and, the exciting times I think we probably have ahead of us for the next few months. So
thanks,
bye for
Mike.
now.
Thank you.
Mike. Thanks.
Thank you.
Bye.
Bye.